Look, I get it. Every time you open a finance app lately, it feels like you're walking into a party where the music is way too loud, the snacks are already gone, but everyone is still screaming that the night is just getting started. But here's the cold, hard truth most people are ignoring. At today's valuations, history isn't just whispering a warning, it's screaming through a megaphone that the next decade could deliver almost zero real return. And no, this isn't some doomer prediction about a sudden market crash. This is just basic, boring, unavoidable math and historical patterns. Right now, we're carrying a massive weight, a Shiller CAPE ratio hovering near 40. Think of it like a hiker trying to summit Everest with a 100-pound backpack labeled price. It doesn't mean they can't reach the top, but it does mean every single inch of progress is going to be 10 times harder than it was for the person with a light pack. Today, we're going to look at the chart, the math, and the three competing stories experts use to justify these prices, and more importantly, what they actually mean for your wallet. We aren't here to tell you to sell everything and hide in a bunker. We're here to give you a reality check compass for the grand arc of history. So grab a coffee, maybe a calculator if you're feeling spicy, and let's figure out where we actually stand. To understand why today's stock prices matter so much for your future, we have to talk about intuition. Imagine you're looking to buy a rental property. You find a beautiful house, but the owner wants $5 million for it, and it only rents for $2,000 a month. That's a fraction of a percent in yield. You might love the house, but as an investment, it's a disaster because you paid way too much for so little earning power. On the flip side, if you found that same house for $200,000, you'd be swimming in cash. Stocks are no different. When you buy the S&P 500 today, you are essentially buying a claim on the future earnings of those companies. If you pay a massive premium today, your future returns must shrink, even if those companies grow their profits perfectly. This is the fundamental law of the mathematical headwind. Price today goes up, so expected future returns go down, all else being equal.
So how do we actually measure if the price is truly high? Enter the Shiller CAPE ratio. Look, standard PE ratios are like a snapshot of a person's health. If he happens to have a cold that day, he looks terrible. During a recession, corporate profits collapse faster than stock prices, making the market look expensive right when it's actually a bargain. For example, back in 2009, standard PE ratios spiked to 130 because earnings vanished, but the CAPE fell to 13.3, signaling a historic buying opportunity. Conversely, at the peak of a boom, earnings are often at their highest, making stocks look cheap just before they fall off a cliff. The CAPE ratio uses a 10-year average to filter out the noise of the business cycle. This cyclically adjusted number gives us a sober assessment of true earning power. We take the current price and divide it by the average of the last 10 years of inflation-adjusted earnings. It's not a tool for predicting what happens next week, it's a reality check for the next decade.
Here is the real X-ray of the market. Every dot on this chart represents a different starting point in history over 150 years. On the far left, you see CAPE ratios below 10. Those are generational bottoms with double-digit returns. But look at the far right. Our current dot is sitting at approximately 40. Historically, whenever we've been in this extreme right tail, 10-year real returns have been lackluster, averaging 0 to 2% after inflation. Statistically, your starting valuation explains roughly 25 to 40% of your long-term return variance. It's like a rubber band. The further you stretch it from the 150-year mean of 18, the harder it wants to snap back. In the normal range of 15 to 20, you'd expect a healthy 6.5% return. But in the 30-plus territory, like 1929, 1999, and today, mathematical gravity becomes overwhelming. At a CAPE of 40, you are betting that the constraints of history no longer apply to you.
But why is it so high? Is it just irrational exuberance, or is there a method to the madness? See, experts don't actually disagree about the number. They disagree about why it's high. There are three major camps in this debate: the secular cycle, the structural case, and concentration adjusted. Let's dig into each of them. First, let's look at the secular cycle. This is the camp of the traditionalists. They believe that valuation levels eventually mean revert because demographics and investor psychology always cycle back. To them, the 150-year arithmetic mean of 18 is still the only true fair value anchor, and history tells us every time we stretch this far, we eventually snap back. But then we have the modernists making the structural case. They ask a fair question. Is it actually logical to use a yardstick from 1880 to value a 2026 digital economy?
They argue that we're making a category error, like trying to measure the speed of a jet engine with a sundial. This group believes the US market has undergone fundamental shifts that justify a much higher fair value than the historical mean of 18.
To understand their logic, we have to look at 4 key shifts. First, consider interest rates. Since the 80s, global long-term interest rates have trended down. Low interest rates lead to lower discount rates for stock valuation, which justify higher PE multiples. Essentially, investors accept a high CAPE today and thus lower return because the alternative, bonds, looks so unappealing. Next, look at the evolution of the index itself. The S&P 500 of the 1900s was a heavy metal graveyard of railroads, utilities, and steel mills that needed massive factories to make a dime. Today's leaders, like Apple, Microsoft, and Nvidia, are asset light. These firms can scale their revenue to billions with almost zero marginal cost. These tech titans naturally command higher PE multiples because of their insane growth and profit margins. As they take over the index, the aggregate CAPE should logically drift higher.
Then there's the accounting glitch. Under modern accounting rules, when a company builds a physical factory, they capitalize it and spread the cost over years through depreciation. But when a tech company spends billions on R&D, branding, or software, they have to expense it immediately. This artificially suppresses today's reported earnings while the company is actually building massive future value. We might be flying blind, using an 1880s definition of earnings that fails to capture the true economic value created by a digital corporation. Finally, there's what I call the buyback blind spot. Back in the day, if a company wanted to share the wealth, they just cut you a dividend check. That lowered the stock price, sure, but the number of shares in the market stayed exactly the same. But since the early 80s, the game has totally changed, and now the world is obsessed with buybacks. Check out the data. Back in 1990, only about 45% of S&P 500 companies were actually doing buybacks. Today, that number has rocketed up to nearly 90%. This matters because it creates a massive mismatch. You're looking at today's price, which reflects a much smaller pool of shares, and comparing it to a 10-year earnings average that's still dragged down by the years when the share count was way higher. It makes the CAPE look significantly more expensive than it might actually be.
And that brings us to our third camp: concentration adjusted. This view argues that the market is currently a tale of two cities. They point out that the Magnificent Seven are wildly expensive due to the AI narrative, accounting for over 1/3 of the entire market's value. If you strip those giants out, the S&P 493 has a CAPE of 33. That's still expensive, but it's a lot less exuberant than 40. Now, these three stories aren't just for winning arguments at a cocktail party, they actually dictate the size of your future paycheck. Let's look at the cold, hard math of how these different scenarios change your expected real return over the next 10 years. Scenario 1. The secular trend. If you are a traditionalist who believes the 150-year mean of 18 is the only true anchor, the math is, frankly, terrifying. Reverting from nearly 40 down to 18 implies a multiple contraction of over 50%. That's a massive 8% annual headwind. When you add back your fundamentals for growth and dividends and assume a partial reversion, you end up with an expected real return of -2% to 0%. This is the classic lost decade, where you actually lose purchasing power every single year. Scenario 2, the structural change. Now, what if you're a modernist, as we discussed? If the new normal is actually the post-1980 mean of 24 because of those structural shifts since the 80s, the drag is a bit lighter, about -5% per year. This leads to an implied return of -1% to +1%. It's better, sure, but it's still a far cry from the historical 7% we all crave. Scenario 3, concentration adjusted. Finally, let's look at the tale of two cities math. If we assume the S&P 493 reverts to a mean of 24, the drag is only 3%, giving you a little breathing room of 0% to 2%. This suggests the average company isn't in a bubble, but it's definitely sitting in a very expensive neighborhood with a very thin margin of safety. When you step away from the fancy math models and look back at history through a wider lens, all three of these stories usually end up in the same bucket. When the starting CAPE is above 30, historical 10-year returns tend to center around 0% to 2%. Sometimes it's a bit higher, sometimes lower, but on average, it's low. History doesn't care if you think the right anchor is 18 or 24. When valuations are this high, the distribution of outcomes simply shifts downward.
Notice the pattern. Even if you pick the most optimistic story, the one where interest rates stay low, buybacks stay high, and we ignore the tech giants, the math still only gets you to about a 0% or 2% real return. This is why almost every serious analyst today lands on that 1% number. It's a compromise between mean reversion and structural optimism. Essentially, it tells us we've likely pulled forward the next 10 years of gains into the last 5. We've already eaten the dessert, and now we have to sit through a decade of the main course with no sugar left. This is what a lost decade looks like. It's not necessarily a massive crash tomorrow, but a long sideways grind where stocks post tiny positive returns that trail inflation or earnings growth.
So if we're staring down a future of 0 to 2% real returns over the next decade, what does that actually look like on a day-to-day basis if we assume the CAPE ratio has to eventually come back to Earth? There are really only 2 ways for that valuation gravity to kick in. Possibility 1, the hard way. This is the classic market crash scenario. In this version, the market craters, multiples contract violently, and then prices spend the rest of the decade slowly climbing back to where we are right now. Now, the depth of that drop depends on which anchor you believe in. If the CAPE has to return to the traditional arithmetic mean of 18 or 24, we're talking about a massive 40 to 55% contraction in multiples. However, some argue that because of those structural shifts we talked about earlier, the fair value has been climbing steadily along a long-term trend line. If the CAPE only needs to reverse to that trend line, which currently sits around 24 for the 150-year chart and 34 for the 45-year chart, the contraction is a bit less painful, ranging from 15 to 40%. Of course, that's the clean math. It doesn't account for the emotional overshoot that almost always happens during a panic. Now, possibility number 2 is the sideways grind. Theoretically, the market doesn't actually need to fall off a cliff to get back to its mean. It can also fix its valuation through what experts call earnings catch-up. This is where corporate profits grow faster than usual while stock prices just hang out. Basically, the denominator grows into the numerator, and the ratio settles back to Earth without a single Black Monday headline. But, and this is a massive but, historically, we haven't actually seen this happen yet. History is pretty blunt about this. Whenever the CAPE has stretched past 30, it's ended with a violent snap, like in 1929 or the dot-com bust of 2000. Even as recently as 2022, we saw a deep, painful adjustment of 25%. You might not call that a full-blown crash, but it sure felt like one to anyone watching their portfolio bleed. So we've looked at the math and the scenarios, but what do you actually do with this information tomorrow morning? First, lower your expectations. If your retirement plan is banking on 6% or 7% real returns from US stocks, you aren't planning, you're praying for a miracle. Start using 1% or 2% for your US equity projections over the next decade. If that adjustment breaks your financial plan, the best time to start saving more is right now. Second, look globally. The Shiller CAPE is a phenomenal tool for finding value outside your backyard. While the US is partying at a CAPE of nearly 40, there are emerging markets trading at CAPEs below 16. History is very clear on this. The cheaper region usually wins the next decade. Third, don't try to time the exit. As great as the CAPE is for long-term planning, it's a terrible tool for short-term market timing. Valuations can stay irrationally high for years while the new era perception runs its course. If you sell everything today just because the CAPE is high, you risk missing out on the most explosive final melt-up phase of a bull market. Ultimately, the Shiller CAPE isn't a sell button, it's a filter for your expectations. It tells us we are standing in a low probability, high valuation environment where the easy gains of the past few years are likely gone. Whether you're a believer in structural shifts or secular cycles, a 40x multiple demands caution. Don't abandon equities. They are still the premier tool for building long-term wealth, but make sure your portfolio is diversified and your plan is robust enough to survive a decade where the market does nothing but catch its breath. Price matters. It always does and it always will. That's the lesson. If this helped you see through the market noise, hit that like button and subscribe. It really helps the channel. I'll see you in the next one where we continue breaking down the tools you need to gauge market valuation. Thanks for watching.